Hello, money and banking students. In this video, we will take a look at the savings and loan crisis. We'll look at some recent regulatory reforms and also some things that came out of the Basel Accords. We'll start with the savings and loan crisis of the 1980s, and specifically, we want to learn how regulators made the savings and loan crisis worse. Since most of you were not alive when the savings and loan crisis occurred, I'm going to play a little video that provides some of the history and background of the crisis.
The savings and loan was once a fixture of the American landscape. It was an association of like-minded people who lacked sufficient savings of their own to buy or build a home, but could afford to do so by pooling their resources. Over time, as the borrowed funds were repaid, along with interest, the savings pool grew, expanding the number of loans that could be made. This was important because traditional banks didn't lend on residential mortgages at the time. The English author Daniel Defoe, who is known to us for writing the novels Robinson Crusoe and Moll Flanders, suggested this very concept in his 1697 proposal to form Friendly Societies for Provident Habits in General. Later, a Scottish clergyman, the Reverend Henry Duncan, organized the first savings bank in 1810 for village parishioners. His intent was to encourage the poor and the working class to reduce poverty through their collective savings. In 1816, the U.S. Congress authorized savings bank charters, the first of which was realized in Philadelphia. And in 1831, the Oxford Provident Building Association opened in Frankfort, Pennsylvania, offering loans in a 5-mile radius. And in the early 1930s, the more contemporary savings and loan, with its federally insured deposits, was created to help resuscitate the mortgage market during the Great Depression. Sometimes known as thrifts, S&Ls operated like banks in that they took savings deposits and made loans. But they were focused on households. They took deposits only from individuals and concentrated on mortgage lending. S&Ls were popular because they offered slightly higher deposit rates than the banks, which in any event preferred to lend to businesses. In addition, most S&Ls were small, local institutions, and nearly all were owned by their depositors. They knew their customers and could cut you some slack if your mortgage payment was late. Not surprisingly, S&Ls became the main mortgage lending institution in the U.S. economy. During their heyday, their share of the market was as high as 44%. They weren't terribly profitable, but they were generally financially solid. After the Federal Home Loan Bank Act of 1932 created the modern S&L, only about 140 institutions failed in the first 45 years, less than 4 a year on average. That implies a failure rate of less than 0.1% a year. The picture started to change during the 1960s and 70s when inflation took off. As inflation rose, so did interest rates. Rising interest rates were bad news for all financial intermediaries, and especially for S&Ls. The first problem was that federal regulations capped the rates that banks and S&Ls could legally pay on their deposits. Why was that a bad thing? Well, when market interest rates rose above the deposit rate ceilings, then households would pull their deposits from the S&Ls and put them in higher-yielding instruments, particularly in increasingly popular money market mutual funds. S&Ls had to do something to hold onto their deposits to keep the asset and liability sides of their businesses in balance. It would have been virtually impossible to fund long-term loans like 30-year mortgages with deposits subject to short-term ebbs and flows. So they started to give incentives to their depositors in the form of expensive home accessories like wall clocks, cigarette lighters, and stainless steel flatware. By the end of the 1970s, it was a common joke that the place to get a new toaster was your local S&L or bank. One thrift in Beverly Hills, California, raffled off a new car, a mink stole, and a color TV. Giving away prizes was a way to get around the interest rate ceiling by paying interest in kind, in the form of goods. And it worked fine until interest rates really started to spike in the late 1970s and early 1980s. At that point, toasters just weren't cutting it anymore. S&Ls had growing difficulty competing, and many in the business feared that the industry was headed to extinction. But some S&Ls had lobbied Congress and their federal regulator, the Federal Home Loan Bank Board, to allow them to offer more competitive interest rates. And in 1978, S&Ls were allowed to offer new deposit accounts that paid much higher rates of return. These were still not quite as high as people could get from a money market mutual fund, but was enough to avoid a massive flight of deposits. This partial deregulation, however, created a new problem. The S&L's effort to attract new deposits and retain existing ones meant that their interest expenses went up a lot, even as their interest income essentially held steady. This happened because the S&L's assets consisted of mortgages that they had made during the past 30 years, when interest rates had been lower. And the interest rates on these mortgages were all fixed. For example, an S&L that made a mortgage loan in 1966 at an interest rate of 6% would receive payments fixed at this interest rate until 1996, when the mortgage was finally to be paid off. Yes, more recent mortgages would earn greater interest, reflecting higher contemporary rates. But new mortgages accounted for a small share of the total mortgages held on an S&L's balance sheet. In those days, borrower and lender both typically held the same mortgage from origination to maturity, decades later. Depositors had much greater flexibility to withdraw their savings and reinvest at any time. This led to a significant migration from lower yielding to new higher yielding deposit accounts. And it meant that the typical institution's interest payments went up significantly. As a result, the difference between the interest S&Ls earned from their mortgages and what they paid out in deposits declined dramatically and even turned negative. This spread, or net interest margin as it's called in the banking business, dramatically shrunk the industry's profitability. Many S&Ls started to lose money. In 1980, for example, 1/3 of the approximately 4,000 S&Ls in the United States at the time reported losses. By the end of 1981, about 85% of all S&Ls were losing money. Clearly, that was unsustainable.
So the savings and loan crisis provides an example of where regulation from the 1930s, which restricted interest rates, banking activities, and competition, actually affected the savings and loans adversely during the 1980s. So because of disintermediation, banks and savings and loans were losing deposits to money market funds. Also, there was deregulation that was encouraging leverage and risk during this time. That led to bank losses. The regulators, fearful of losing their jobs, kind of overlooked what was going on with the S&L's financial statements, and that led to a great number of bank failures. So following the S&L crisis, a number of regulatory reforms were passed. FIRREA basically re-regulated the S&Ls and provided a bailout. Then in 1991, FDIC revised their insurance and actually raised deposit insurance premiums and also the amount of coverage. The Regal-Neal Interstate Banking Act basically allowed banks to expand beyond state lines. And then in 1999, the Gramm-Leach-Bliley Financial Services Modernization Act repealed Glass-Steagall and allowed banks to engage in commercial and investment banking activities. As we say, it blurred the lines. It allowed banks to sell investment products and insurance products, and it allowed investment and insurance companies to sell banking services. What has occurred since the passage of these new regulatory reforms is more competition, and that has led to consolidation, where we're seeing a lot of the small players get out and the bigger getting bigger. More activities, again, more different services and types of activities that are done under the banking umbrella. And that has led to the too big to fail or bigness dilemma, in which the large financial conglomerates, if they would fail, would basically cripple the economy. And so oftentimes they receive special treatment from the government because can't risk the fact of failure. In 1988, the first Basel Accord was held in Basel, Switzerland. That was held by the Bank for International Settlements in an attempt to come up with some new measures to measure bank risk. And one of the things that came out of that was risk weighting, where not all assets are created equal, where we have to take into account the risk for certain assets before we adjust them and use them in our average capital ratio weighting. Basel II in 2008 basically brought about 3 pillars of regulation. Capital, in other words, what do minimum capital amounts need to be, a supervisory review process, and then market discipline for those who do not follow the rules of the Accord. The supervisory review process, there's an acronym for it, it's called CAMELS, looks at capital, asset quality, management, earnings, liquidity, and sensitivity to market risk. But although the intent of Basel II was good, problems have arisen, and you can see all the different issues that have arisen here on this particular slide. Market discipline, basically, rather than being seen as adversaries, premise was that bank regulators should be seen as aids in helping the bank stockholders and depositors by keeping them in line. However, in some less developed countries where corruption is a problem, sometimes bank regulators are subject to bribes and maybe on the take. Of course, the 2008 financial crisis interrupted the implementation of Basel II and led to a Basel III conference in 2019. In 2010, the Dodd-Frank Wall Street Reform and Protection Act was introduced in an attempt to make our financial system less fragile. Dodd-Frank basically brought about several things: Financial Stability Oversight Council, Office of Financial Research, Consumer Financial Protection Bureau, an advanced warning system that will attempt to identify and address systematic risks before they threaten financial institutions and markets. Dodd-Frank brought about more stringent capital and liquidity requirements. It required banks to keep more in reserve, tougher regulation, breakup of large capital financial institutions, tougher restrictions on bailouts, and supposedly more transparency of asset-backed securities. Verdict's been mixed, though, just like any other regulatory action. Another premise of Dodd-Frank was to regulate or put more corporate governance responsibility on executive compensation, because one of the sour points for consumers was financial institutions got large bailouts, but yet, corporate CEOs of banks and financial institutions were receiving large bonuses and even large buyout packages even when their institutions failed. So Dodd-Frank put an attempt to put more responsibility to corporate governance on CEO compensation. Again, the verdict's been mixed on that. So again, make sure to follow Moodle, complete your discussion forum questions as well as the quiz for this week, and we'll talk to you soon.